Hello, let's start in the United States of America, comme d'habitude. And what we've got is real disposable personal income in blue and real personal consumption expenditure in red. So real, meaning inflation's been taken into account, disposable personal income and personal consumption expenditure. A note on here that I dragged it all the way to the top to get was over this period, which goes back to 1966, we've got an average real disposable personal income growth at 2.5%, and through the period, average real personal consumption expenditure growth at 2.8%. And you can see obviously the Great Recession smashed that completely, going down towards -3, -4. But obviously what we're looking at now is the numbers for today. So real disposable personal income is heading down towards 0% growth again. And this is what this video presentation thing is all about. Disposable personal income, getting the money to the people of the United States so they can spend it. It's a problem for the United States and it is a problem for the world. Somehow, somewhere along the line, money has got to be got into the hands of the people of the United States of America, or things aren't just going to work properly. Right. Economic pick data gives us this leading economic indicators for the United States of America. It looks all very gay and jolly, and it takes a bit of looking at. I've been through it once before, but I won't go through it again. I'll just do the lines that are linked up by little square boxes in blue line and the brown line. Now the brown line that's up in the positive region is the LEI index that the economic pick data people think are controllable by the Fed and have been controlled by the Fed Treasury government, all the same. And the blue is outside the Fed's control. Now, the ones controlled by the Fed have been coming down from July, August, September, but the ones out of the Fed control have been coming up. And it's all a very mixed picture at the moment. And I think what we can say is the United States is not double dipping. It's just not going very far, very fast. It's just there. You know, it might even be 2% growth, which is not good, it's not bad, it's just iffy. And waiting on the government to see what they do. But running up to the presidential election, they're going to continue with what is probably keeping it positive, which are the deficits of over $1 trillion, which I think officially are about 1.3 trillion, which are probably a bit more when you really look into the figures. But it's probably that deficit that is keeping the United States positive on the growth front. Bloomberg. Now I've pulled this out because I'm going to link it out to the rest of the world. And what could be helping the United States? I know that the whole United States doesn't get their oil at WTI prices, but quite a lot do. And the Cushing spot is there at 87, but the rest of the world is paying 111. Now, this could be why the rest of the world is struggling more than the United States is. And I've highlighted natural gas there because United States is getting a bonus at the moment from cheaper natural gas as well, and could be for a little bit into the future as well. So all in all, I think the investing world will be putting their money into the United States, withdrawing it from the rest of the world. Which brings us to this chart, which is the USDI, the US dollar index. Only goes back to 2009, but you can see it had to spike up when in the last the world's going to end, people put their money into the United States, because when push comes to shove, you don't bet against the big boy. Now, it's turned down lately, you can see at the end of that chart, where people for some strange reason are betting that the euro is going to all work out all right. But the 50-day moving average, the red line, is on its way up. And if the rest of the world goes down into a recessionified thing, then more money will flood into America, pushing up the value of the dollar. Now, this could lead to less inflation of prices in the stores in America, because the buck will buy more on the world market. But it will also lead to the loss of more manufacturing jobs of any people in the United States that were thinking of building in the United States to export to the rest of the world. But it is, in a way, a short-term fix for the rest of the world. The dollar gets strong, and the people of America then can buy more stuff from the rest of the world. So chief among these rest of the world people are HSBC Flash China Manufacturing, and you can see it's turned up nicely. It was on its way down. It went below the 50, and it's decided, nope, don't like it down there, on its way back up above 50. Obviously it's just hovering about that line, and anything could happen, but it's certainly not plunging down below 50 into negative territory, or at least contractionary territory. Right, so that looked good for China. This doesn't look so good for China. The blue line China business indicator, not so important here, much more important the money supply growth in China. This is going back to 98, and you can see where it is now, poking down below that box saying money supply growth China. It's almost at one of its lowest levels since that chart started in 98. And it's hard to grow your economy on shortages of money when everything's kind of bubbly. But the world's too big, China's too big, very complicated to anybody to try and work out what to know about it, and certainly too hard for the central planners in wherever they are, Beijing, to try and work out exactly what to do. So guaranteed, if they do anything really large, like shrinking the money supply like that, it's going to be good luck, better luck than judgment if they get it right. And the world is betting against them getting it right. This chart going back to 2005, they were doing well, then the Great Recession, and then China really, when it was that G20 meeting, they really pushed an awful lot of money out at the end of the last 5-year plan and coming to their elections, and everything did boost back up again. But you can see certainly the iShares FTSE Xinhua China 25 index is on its way down, and generally the world stock markets kind of follow China for some reason now, and China's stock market is on its way down, not up. Money, direct foreign direct investment is coming out of China. The general trend is fear and bringing money out of the emerging markets and putting it home, which is the United States driving up the dollar. New York Times, absolutely amazing chart that they put together. You'd need one of these super big televisions to really look at it properly on, but even on my reasonable size monitor you can get to see that they've done wonderful work putting this together. It boggles the mind, it really does. It's all connected, as they say, a spectator's guide to the Euro crisis. Marvellous work. Whether it actually educates anybody, I don't know, but it is, in its own way, brilliant. Finish with Cantus Economics, which hopefully should be able to bring this whole story round again. Guest post by Henry Caspar, The Irish Lesson, or Its Competitiveness Stupid. Now, In the euro at the moment, we know there's a lot of talk going on at the moment, but in the background there are some real things happening in the periphery countries, which have been noted by the markets with their CDS spreads, credit default swap spreads, on their sovereign bonds. Start at the top with the blue and the red lines, Ireland and Portugal. Ireland has been deemed, I've noted it a few times, they're really working at it very hard. They're really working at it. It's just marvellous what they're doing. But I'm doubting that it's a long-term cure for either Ireland, Europe or the world. But for the moment, it's what is called for by the European community, by the IMF, by the World Bank and everybody that says Ireland is doing well by doing what's over in the top right-hand box, bringing down their unit labour costs. They're making their labour cheaper, paying their workers less. In other words, there will be actually less demand in Ireland, but there's more likely that stuff will be made in Ireland. But can you see what I'm trying to get at? That is short-term good for Ireland, but is it good for the world? Because there's all this manufacturing capacity at very cheap rates, but very few people out there with enough money to create enough demand for all this manufactured stuff. But for the moment, it's working for Ireland, as opposed to, in contrast to Portugal in blue, where their unit labour costs are still going up and their CDS spreads on their sovereign bonds are going up. In other words, if you can't get your labour costs down, foreign direct investment isn't going to come in, and you're not going to get to manufacture things, you're not going to make for growth, and you're not going to pay back your sovereign bonds because there won't be enough money circulating through the government. And same between Italy and Spain. From the summer, the markets have been trying to work out which one is the basket case, and we can see that Italy, Berlusconi got a kicking from Mercosi yesterday, and this is why, because unit labour costs in Italy, if anything, are still going up. So their CDS spreads are going up. But in Spain, their unit labour costs, the price of labour in Spain is going down, and the CDS spreads on the sovereign debt are going down. But once more, just repeat, if everybody brings their labour costs down, that will bring demand down. And there's no point doing all this manufacturing unless there's the money out there to buy your gear after you've made it. It's a world problem which I think short term will be worked out by the United States going back to its normal role of buyer of all gear, all stuff, with a stronger dollar. That will ruin more US manufacturing, but it will work short term. That's it. Have a good week. Bye.